Hello and welcome. This is BQ Prime. I'm Agam Vakil. We're taking stock of the markets and where they have been and where they're headed going forward. Well, the truth is that while we do take a step back from life highs, as far as valuations on the benchmark indices are concerned, well, they're still trading at a little bit of a discount when you consider the historical valuations. That said, there are still a certain pockets which continue to move ahead, and on the other hand, we're also starting to see just a little bit of fatigue in certain other sectors in the markets. But let's try and understand this better. And let's bring in a guest who actually has been around for much longer than many of us have been around for. And pardon me, well, let's bring in Devina Mehra. She is the founder, chairperson, and MD at First Global. Devina, good morning, and thank you so much for joining in. Uh, Devina, I'll start with the first question. The last time you spoke to BQ Prime, you said that we're still closer to the beginning of the move rather than the end of the move. Even before that in March, we were at a lot lower levels. Since then, of course, we've hit new life highs. The question really is that how much has factors in the underlying markets changed over the last 3 months, and where do we go from here?
Good morning, Abhay, and good morning to the viewers as well. And thanks for making me feel old. I mean, you're right. It's almost exactly 30 years since I started as an entrepreneur, since I started First Global. So I resigned end of August, and after the notice period started on 1st October. So it's almost exactly 30 years.
Well, that certainly
And
wasn't the
as far as
intention, Devina.
I'm only joking because I was telling somebody, I mean, I was always used to being the youngest in class, right from class one to my MBA, which I joined when I was 19. So,
Right.
it's, uh, so that's a role I'm more used to. Okay, so coming back to the question on the markets, there is, I mean, you mentioned March. Actually, I tweeted in March that this is the time to get in. And I had also said that if you're asking me, is this the bottom? I don't know, but I mean, it is certainly in the range. So, that played out, of course. So, where we are sitting today, as you mentioned, the valuations are not particularly stretched. That's one part. Also, if you look at the market itself, again, you step back to take the long view. If you think of the Indian markets, most people think that equities give you 15, 16% return. Those are the returns from the time, let's say, the Sensex started. So, but what people don't realize is that how much of a variation there is. And I'm not talking just variation on a year to year basis, but also on a decade basis. So, if you invested in the Indian indices at, let's say, 1980, in a decade's time, let's say you invested 100 rupees, that would have become 700 rupees. But if you had invested in 2010, in that decade, that 100 rupees would have become only 230 rupees, which was not much, given where inflation was, and given fixed deposit rates used to be 7.5%, and the equity market gave you 8.8%. So it didn't certainly compensate for the risk of the investing in equities. So once it came out of that kind of underperformance in the early part of this decade, I was quite clear that that would continue. Also, relative to the globe, in that 2010 to 20, we were underperformers almost every year. So that again changed. And last year also, which was a very bad year for global markets, while we were not up in dollar terms, we were certainly in the outperforming bucket. So that's the background. So normally what happens is that the big crashes, or the risk of a big crash, is when you are far above the trend line. You're not even at the trend line, because this decade also, because of global factors, you have only compounded about 12.5%. So, not at the historical average, even let alone make up for that huge underperformance of a decade. So that's when we are talking the mainstream indices, the large cap indices like Sensex and Nifty. Now, of course, as you know, I mean, while from the March lows, when I had tweeted that, the index was not even 17,000. So, it's obviously had a reasonably good run since then. But the part that has had an even better run has been the small cap. and small cap and mid cap. And there, people again do not look at history. So I was doing this exercise, and if you look at that 2008 high of small caps, from there they fell 78% over the next year or two, and even the recovery took a long time. So that 2008 high of the index was hit next in 2016, and I'll come back to that, what that means. And but even that bull run, that 2016-17, didn't last long. So 2018 you had onwards, 2018 to 20 you had another crash taking the market down, uh, I think 65%. So now this is the background for the small caps, and people have these very quaint notions that the index might not do well, but I'm picking my stocks carefully, and my stocks will do well. So I looked at the statistics for that as well. So in that 2008 onwards crash, only 1% of the small caps were up by the end of that fall. And in this, even in the 2018 onwards fall, the only 8% of the stocks were up. So, I mean, it would be, I would put it mildly, foolish to think that you will have only those stocks in your portfolio. So, if if the market crashes to that extent, you will get hit. I mean, long and short of it. And also, now this I was talking the small cap index, but actually the other interesting thing is this, that the small cap index itself churns 18 to 20% every year. So for all practical purposes, in 5-6 years, it is a completely new index. So now this means that the stocks that made, I mean, that crossed that high in 2016 were not the same stocks that were in the index in 2008, most of which disappeared, became penny stocks, became worthless, basically. So point is, this is a risky end of the market. So you should limit your exposure to the small caps, even though I remain positive on the larger caps. I mean, I think the time to be cautious, because again, from the March lows, those rallied 40+%. I was looking at mutual fund flows. They have also all been coming in small caps. In fact, the large cap flows have actually reduced. So they haven't even gone up in the last couple of months, whereas small cap, everybody's coming in. And then you have new schemes being launched, and I see in social media people saying that I called up this AMC service personnel for some service stuff, and they started to push their small cap fund. So, I mean, these are all signs of fraudiness, signs of being closer to the top here. But the same is not the case for the large caps. I mean, broadly, that's the picture.
Right. Devina, I do want to take the point of the mid caps and small caps forward, but before that, a macro question on crude. It's now at a near 1 year high, and that's always going to be a little bit of a pain point when it comes to the economy, especially when the markets are looking forward to rate cuts somewhere down the line next year, maybe the year following that. What's your assessment here?
So, you're talking rate cuts in India or the US?
In India.
Okay. So, crude, yeah, I mean, crude has been, I mean, our assessment of crude is that it will be in a band, maybe 90 to 110 kind of thing, but more with an upward bias rather than a downward bias. So, putting all the factors together, that would be our base case uh, right now. And yes, you are right that the crude coming down. Earlier in the year, I had said, somebody asked me that, what do you think will be the one theme? And I said the crude is down significantly from last year. And that's a driver on many things for India, from current account deficit to inflation to even corporate earnings, because so many of the inputs are petro-based. So this is definitely a negative. So for India and for even for some of the corporate earnings, but it's not like a way out number still. So I mean, it's at a manageable stage. As far as the rates are concerned, the inflation has been very high, mainly driven by food, of course, in India. And while food inflation, you say, I mean, arguably has nothing much to do with interest rates, and therefore you should not be using interest rates to control food-driven inflation. But the fact is that the central bank also has to manage the inflation expectations. And while RBI has had a growth rather than an inflation control bias in this cycle, so they have been reluctant to raise rates. They have done it only when they were absolutely had to. But I don't see rate cuts either. And if inflation continues to remain high, which I think it should moderate, but I mean, if it continues to remain high, then of course, that you can't rule out a minor hike also.
Right.
So I have anyway, whether it was India or US, I have never been of the view that you would see the rate cutting very quickly, simply because inflation doesn't come down that quickly if you look at history.
Right.
So even if in the US, when everybody was expecting a rate cut in 2024, if you see my interview, so the last year and a half, I never said that because I was quite clear in second half of 2023, I never said that because I was clear that historically inflation is that high, it doesn't come down in 2 quarters or 3 quarters. So it's only wishful thinking to think, that would come down very rapidly.
Right.
Only places where rate cuts have started are the countries where the rate hikes happened much earlier.
Hmm.
So, in 2020, see, we watch only US and India. We forget about the rest of the world. And in 2021, a lot of emerging market central banks had raised rates, not just once, but two, three, four, even the outliers were 5, 6 times. So a couple of those countries like Brazil and Chile have started to cut rates. But then, as I said, their cycle started much earlier.
Right. So, Devina, I'm going to shift focus back to Indian markets. Well, I'm assuming that the markets here on will be less secular. The question here is to do with mid caps and small caps. Uh, you have in the past tended to say that you have an allocation of around 25 to 30% towards, some of these smaller names. And please do correct me if I'm wrong. Are your systems starting to take money off the table at these levels? And what would the allocation be at the moment when it comes to some of these mid cap and small cap counters?
Okay, Abhay. So first of all, our systems, I mean, the way we run the money is very, very focused on risk management.
Yeah.
So we always say that, more of your fees go for risk management rather than return management. That's been the cornerstone of our philosophy that, that avoid the big drawdown because investing is a loser's game. You win only if you don't lose. So you have to make sure you don't lose a significant part of your capital at any point. So and those risk management systems have worked very well even in real life stress situations. So I mean, not only did we sidestep the COVID crash with Indian global all products down only 8 to 10% as against 30 to 40% for most fund managers. But even last year in the Russia-Ukraine war, the day the war broke out, the market was down 5%. We were down 1.6. So we have about 7, 8 steps in that. And one of them, of course, also is that we limit our small cap exposure, not just in our PML, but even in our small case. So, when there is great momentum, we might go from 15% small cap to 20% small cap, but we're not going to go to 40% small cap. Of course, mid cap is another category, and we don't invest in micro cap, so nothing beyond 1,000 crore market cap. We also, market cap is one thing, but we also have a lot of liquidity filters. Because the problem with small caps also is not just, when the crash comes, it's not just that the price goes down, but that really there is no exit. So all those things which will look very liquid on the way up are no longer liquid. So we put all those things together. So we would be little over 50% in large caps, probably less than 20% now on small cap, maybe 18 or something, and uh, about uh, maybe about 30% in mid cap. So that would be our, of course, see, I mean, our systems really, the bottom up system really comes up with the stocks. So we really go with that. So those are, you can say, little more. There, of course, it's a bottom-up engine, but we also keep a handle on how much the sector allocation is. So again, as a risk management measure, we will never have 40% in a single sector or anything close to that. So our sectorally also, we are fairly well diversified. So and it's served us well. I mean, the 3.5 years since we started, not only are we number one in terms of returns in the large cap, multi cap space, but in risk adjusted returns, whether you adjust for volatility or drawdown, there's barely anybody at even half our levels.
Right.
So that's the way and therefore individually also, if you're managing your money, I always say that limit all these things, have strict stop losses. That's another leg of the risk management. So you have to manage the risk.
Right. Devina, just a question out of curiosity. Do you guys use the factor of cross-sectional momentum? And for the benefit of viewers, this is relative strength, that is, a one stock being stronger as compared to the rest of the market. Do you guys use this factor? And if you do use this factor, to what extent do you have weightage towards this? And how and what are those stocks or sectors, for that matter, which are starting to pop up at the moment?
Okay, so the way we manage money is what we call a human plus machine system. I see some people copying the title now, but the substance of it is a lot more difficult to copy. So it's almost now almost 2 million lines of code that we have on an artificial intelligence machine learning system, which where you try to codify all your expertise and then also then test it out and keep refining it. So we actually look at we start with literally hundreds of factors, but all the factors must be logical. So then that's another story altogether. So we have they're primarily fundamental driven factors, but we do have some momentum factors. But the kind of crude thing you were talking about, just relative strength and all that, but that is not good enough to uh, give you a good signal to do anything, because and this I'm talking not just like never having tried it. We have fairly elaborate momentum and uh, technical factors driven systems which we've been refining for a good 20 years plus. So this is the AI/ML system I'm talking about is separate. These are other systems which we do use, for example, to catch a commodity turn, or uh, even for other things. But what over the years I have learned is that looking at momentum, or especially the kind of crude stuff you see on television every day, trades for the day and all that, that's all fairly pretty much nonsense. And I'm talking, as I said, with systems which are more elaborate than what most of these people are using. In fact, many of them are ex-FG who are stuck where we were 15 years ago, but that's another matter. Where these things help you at the most is at timing a trade that you have identified fundamentally. So that's where I found that some of these market timing things help you there, that you think you should be buying this stock, and so you can time, you can watch it for a while. I'll give you an example. Like Japan, we had identified early in the year, and then we were watching for the turn, which came around April. So that's when we went overweight Japan. And now for the last couple of months, we've been watching China for a similar turn. So but I mean, if you're talking sectorally, we actually rerun all our systems. We have a quarterly rebalance. So the September end is still to happen. But so where we rank all stocks from, let's say in India, there are about roughly 750 stocks that are about the 1,000 crore market cap. So we rank everything from 1 to 750 on all factors together. And the machine combines it in much more sophisticated ways than you and I do. So it's like how the combination, what is the optimal combination of factors. That's another type of whole system. But what we have found, I mean, and if you want to talk sectors, the sector that our systems identified almost 2 years ago, so it was in the October 2021 rebalance, was capital goods and industrial machinery. So we've been overweight that sector for almost 2 years now. I mean, people have started talking about it in the last few months. But the question actually we've been asking every quarter is the run over? Until now, the systems have not signaled that the run is over. Of course, some stocks went up 2 times, 4 times, we booked profits, we changed the allocation within the sector, all of that. But I mean, broadly, that sector still remains our most overweight sector. This calendar year, places where our systems have liked and we've added has been auto components, pharmaceuticals, a few construction companies. Of late, we have cut banks, And of course, I mean, this is, as somebody was telling me, कि ये तो आपका तकिया कलाम है, कि I'm a nervous investor in banks and lenders in general because you don't know where the negative surprises are hiding. So I'm always very careful on that. So that would be broadly the things. I mean, off late, for example, last couple of times, a few of the FMCG names have started to pop up, which was not the case for the prior year or two. Of course, I mean, I'm one of our big winners last year was ITC. So, I mean, that apart, but most of the other FMCG names were not coming up in our system. They've just about started to. So that's another area that we are watching. But in terms of overweight, it is what I told you. IT also will be marginally overweight, not by a great deal, but a little bit.
Right. Devina, I'm just going to conclude with one question, and this is to do with financials. I know you briefly touched up upon that, but the question really is that while the market is still very positive on financials, maybe for the lack of better ideas, perhaps, well, at least consensus suggests that there could be no re rating on the cards going further. Your view on this particular sector?
As I told you, we have cut. See, I mean, throughout 2020 and 2021, we had very little weight to financials, which was quite extraordinary given that the index weight is very high for banks and NBFCs. Uh, Middle of 2022 is when we thought things were changing fundamentally, also in terms of credit growth, in terms of the NPA cycle, and also when interest rates go up in the beginning, at least the lenders' margins go up. So all those factors. And and 2020, I mean, I don't know whether you know this, that Nifty Bank was the only sectoral index in the negative. In 2021, also it went up only half as much as the market. I think market was up 22% and Nifty Bank was up only 11%. So when again that trend was changing, so we thought like this is the time to get in. So middle of calendar 2022 is when we went market weight on banks, still not on the non-bank lenders. And but we've started to cut down a bit, so it's and we've also moved, I think, little more to the PSU banks. But overall, now we are underweight, even on banks alone. I mean, let alone financials alone, we were always underweight. Uh, but
Right.
so that's, I mean, as I said, I mean, I am a nervous investor in banks because I know uh, that there are negative surprises. As an outsider, you don't know where the negative surprises are
Right.
hanging, hiding. So unless it is a compelling story, I would like to avoid that. So that's been my philosophy. And now, of course, there is increased competition, all of that as an additional factor for many of the lenders.
Right.
And as I always say that I laugh when lenders say that, we are growing faster than we anticipated. And I say that like, how hard is it to hand out money? Just
Yeah.
collect the money that the problem comes. And maybe having a long memory, which said like all these decades of experience, you remember that all the other times there was a boom in lenders, it comes in different forms. Sometimes there's leasing companies, sometimes it's something else, this time it
Right.
is fintech. So I mean, you always have a skeptic's hat on as well. So.
Well, fair enough. Fair enough. Devina, we're out of time. It was an absolute pleasure chatting with you. Thank you so much for giving us your insights on the markets. Well, signing out for now. This is BQ Prime, and don't go anywhere. There's lots more lined up, so we will keep bringing you more.